and gentlemen, welcome to the Business Brew. I am your host, Bill Brewster. This episode features Jeremy Raper. Jeremy has been on the show before, but came back. He's doing interesting things in some smaller companies. I highly encourage doing your own due diligence and such, as always. But I want to talk to Jeremy because he's gone down it appears to me, a slightly different path than he has been on in the past, and he's going more activist, and he's trying to identify value situations and then get the value out. And I am interested in talking to people like that. So I've known Jeremy a while, and again, here he returns. As always, nothing in this show is investment advice. All of the information contained in here is for entertainment and educational purposes only. Consult your financial advisor before making investment decisions. Do your own due diligence. Thank you to the past sponsors of the show, all of them. I appreciate it. We got Stream by AlphaSense. We got Stratosphere, Koifin, Delupa, my man at Bastier Partners. So thank you to everybody for supporting it. Thank you for your ear, and have a good one. Jeremy Raper returns, folks. Jeremy, how are you, sir?
I'm good. Been a while. Well, I'm trying to remember when we last chatted. It was definitely post-COVID.
Yes.
I'm trying to remember when.
It was a long time.
Maybe late 2020, early 2021?
Early 2021, I believe, yes.
Yeah. Good to see you.
It's nice to see you as well, sir. How's life?
I've had better weeks.
Yeah? Why is that? It's just Monday where you are. The week hasn't even started.
Well, sorry. Yeah, I've had better multi-week periods. Let's put it that way.
Okay. That's fair.
I mean, obviously the geopolitical situation is kind of depressing on many fronts. So that's kind of been weighing on me in a few ways. I'm not sure how much you want to go into it, but I heard your pod with Aaron and, sorry, I forgot the other gentleman's name, but the other guest you had on.
Stu.
Talking about the Israel stuff. That was a really great pod. I really appreciated that. But yeah, so that's been weighing. Obviously the market's been, I kind of been taking on the chin a little bit October's been a pretty rough month for me. But swings and roundabouts, can't complain. Everything is fine. I'm lucky in the grand scheme of things. So what's that quote? Is it a Gandhi quote? Maybe it's not Gandhi, but be kind. Everyone you meet is fighting a harder battle. I always try to remember that. So
that's very nice.
It's true.
Yeah,
I think it's
a good
be
one.
kind to others. Everyone you meet is fighting a harder battle. It's words to that effect, which is very true for all of us in the West, at least.
Yeah, that's factual. As it pertains to markets, where are you playing around? Because what I have seemed to notice is smaller and less liquidity, at least from what I see on my screen, just seems to be getting smashed. But maybe there's a reason. I don't know. Look,
it's kind of the same old song, right? Like everyone thought higher interest rates would mean that long duration assets kind of get reevaluated, reappraised, but until very, very recently, it hasn't been that way at all for much of this year, all of this year. And it's really just been the smaller, junkier stuff that's just kind of seen this ongoing liquidity suck come out of it. So look, if you are playing in that space, call it, I don't want to say deep value, but small market cap or mid to small market cap, kind of off the run securities, non-tech, never been a better time to do things. Doesn't mean everything's going to work immediately all the time. I wish it was that way, but finding a lot to do. Frankly, not as much in the US, just because it's funny, right? Like I always used to do a lot in the US, and I thought it was because the US was the best market for opportunities. But what I realized, it was mostly time zone related for me personally. Like if I was sitting in London for 4 or 5 years, it's a great time zone to do the US. You're in the office before the US, you see everything, you have a good view of what's going to happen in the US before it opens, right? And yet you're still, it's still midday when the market opens. So you have basically the full, 5-6 hours or whatever of the trading day to kind of understand what's going on in the market. So a lot of it actually was time zone related, I think, because now I find myself in the complete opposite time zone. The market where I live in Tokyo, so the market opens at 10:30 p.m. and 11:30 p.m. during winter. So it's very difficult to watch more than even the open or the first, hour of trading or whatever, if you have young kids. And so I find myself almost, I don't want to say fighting with one hand behind my back, because I'm not like daily trading, whatever necessarily, but I do find it is a bit of an impediment to kind of staying on top of things when markets get very volatile if you're not actually in touch with the business day. So maybe it's less about the actual market trading and more about, well, I need to connect with an executive at XYZ company. He's not going to call me on my business hours. You know what I mean? It has to be on his business hours. But that means, okay, well, his day begins at 10 p.m. my time. So is he going to call me before then? If something's big happening, probably not. So it's going to be his afternoon. So it's going to be 5 a.m., 6 a.m., So it does make it a little bit more difficult to kind of stay on top of some of these situations. So I actually spend a lot less time in the US. I have obviously some exposure there, but I've kind of naturally, without even thinking too much about it, focused on other geographies that are more in tune to where I currently live. And in that process, I've kind of become much more active in regions that I never thought I would be active in. So I am Australian by background, but I never thought I would actually invest actively in Australia a lot, because I haven't done it since I was like 15. And now I come back to the market when I'm 37, 30, I'm 39 now. So I've been doing it for focusing more on Australia, like more time for the last few years. And I've been doing it now for 2-3 years, and it's just like a wasteland. Like Australia is like, I think I said on Twitter the other day, Australia's like the land that time forgot from a value perspective. Like it is a hugely bifurcated market in Australia. You have a huge amount of captive pension money because there's a very strict kind of, it's like the 401k in the US, but it's very, very strict pension scheme essentially, where employers and individuals have to contribute quite a high percentage of their salary towards long-term kind of pension related investments. So it's like 7-8, it's like 8% minimum going up to double digits. Superannuation, it's called superannuation. And so over time, there have been massive institutions that have grown in Australia, just going back, I think this scheme started post-war, so for a very long period of time. And I mean, the vast majority of this money just goes into the Australian market. I mean, I'm sure some of it goes overseas, but it's a large pot of money in a small-ish financial system or a smallish capital markets, right? So you have a very, very top-heavy market in Australia. You have a bunch of banks that are typically very, very expensive, and a bunch of other large caps that, if there's a bit of growth in them and a bit of quality, they tend to get way off the value scale, get very, very expensive. And then at the small end of the pool, there's literally no one doing anything, because everyone assumes that anything under, say, 500 million is a shitty junior minor, or some kind of specky, busted kind of low quality proposition, of which there are many, because there is also a lot of dodgy spec miners and stuff like that. So, I mean, you find the most crazy stuff in Australia. Like just the other day, literally the other day, so I'm not sure when this will go out, but whatever. Anyway, people can look it up as a good case study. There's this company trading at 11 cents called Web Central. I had no position in the stock before this happened, okay? I had not even heard of the company. Web Central, WCG, listed on the Australian Stock Exchange. The market cap is maybe 40 million, 50 million or something. So look, it is tiny, okay? These things are often tiny, but weirdly liquid. So they announce a transaction where they sell one of their divisions for like 3 times the market price, okay? They sell one of their divisions for 3 times the market price, but they sell 2/3 of it, or 70% of it or something. No, I think they sell 80%, they keep 20%. So you put a mark on the remaining 20%. They tell you exactly how much net cash they're getting for the transaction, post-taxes, post-closing costs, whatever. Okay, and you come up with a number that's like that plus the valuation of the residual investment is like 31 cents, 32 cents. Stock opens at 24 cents. There's no debt, there's no nothing. Sorry. And in the press release, they also say the residual business is going to be doing 5 million of net profit. 5 million of net profit, okay? And the market cap opens at like, I don't know, it opened up 150%, okay? So it went from 12 cents to 24 cents, 25 cents. 10% of the company traded between 24 and 28 cents. Of course, I bought a boatload of it. But look, it's more complicated. I mean, it was not like free money at 30 cents, let's say, but at 24 cents, I mean, you're buying it less than the net cash from the disposal. No value for the residual investment, no value for the residual business, which they told you was going to earn. So, I mean, there's a huge skepticism with regard to the residual earnings power of what's left over, right? Because it's a bunch of junky stuff that lost money. So there is some uncertainty there. I'm not saying you should rush out and get it or whatever. I'm just saying, like, as an investment principle, like this kind of stuff, that kind of thing is not that unusual, okay? Like they have, I'll give you another example of one I was involved in where, I actually went activist and kind of we got a lot of value out of it. It's a busted oil and gas explorer called FAR, F-A-R. I'm sure people will be familiar with it if they follow me on Twitter, where The company was trading at like 40, 45 cents. Okay. They had a bunch of cash and an earnout on a soon to be in production oil well in Africa. An earnout because they'd sold their exposure because they had no money. So they had to sell their exposure, but they kept an earnout that would trigger when the field goes into production. Okay. And very simple math. If you just add up the value of the earnout at a punitive discount rate and you add up the cash on balance sheet, that's literally all they had. I mean, they had some weird exploration asset that was worthless. Okay. If you add that all up, you get $1 a share. And the stock was sitting there at 40 cents. Okay. No debt, just a bunch of cash and an earnout and a shitty exploration business burning some de minimis amount of cash per quarter. So the market is telling you that essentially that the shitty management is going to just go and take that cash and burn it on some other bad investment and you'll never get a dime out of it. Okay. So I'm not saying it's trading at 40 cents is the problem, but here's where the value is. Okay. So it's trading at 40 cents and then someone bids 45 cents for it. Okay. An activist investor called Samuel Terry Asset Management. Or maybe it was 50 cents. This is 2 years ago, so 18 months ago. So I'm shooting from the hip. Some activist investor bids like 10% over the current price and says, look, we're going to maximize value, blah, blah. Very vague statement, but bid for the whole company and they'd already acquired like 5% of the company. So I'm just reading the document. I literally found this reading the newspaper. That's the other thing. You read the financial newspaper in Australia, it's like gold nuggets left, right, and center. I'm reading the newspaper and they're quoting the CEO of the company, the one who's burnt half this capital, by the way, saying, that offer looks a little bit light, doesn't it? It's a bit cheeky. And I'm like, oh, this sounds interesting. I've never heard of this company. I literally pull out the balance sheet and I'm like, things worth $1 a share. Like, they're going to fire everyone. They're going to fire you. They're going to send you packing and they're going to pay all the cash out. That's what I would do. So then they're bidding 45, 50 cents. I'm like, wow, that is cheeky. They should have bid like 60 cents. They're not going to they're bidding too low, in other words. I'm like, why didn't they just bid through, right? So then I'm like, well, screw this. And I just buy like 3% of the company as much as I can above the offer price. Because I'm like, why should they do it? I'll do it. You know what I mean? We're not talking Procter and Gamble here, right? So I bought... I bought a few percent of the company. I didn't buy, my assets are not, limitless, but I tried to buy as much of the company as I could. I essentially explained the investment, or the thesis, I guess, to my readers. And then I kind of laid it all out in the public with a letter. I wrote a letter to the board and I said, look, here's the amount of value you've destroyed. Here's why you have no mandate to continue. I advocate for XYZ, a series of, value additive steps, namely 1, board reconstitution, removal of the current CEO. And by the way, this lady had, sorry to say, it's not a personal critique, but she had presided over hundreds of millions of dollars of waste, a number of horrendous key strategic decisions during and in around COVID. And the stock was down 98% in the last 5 years or whatever, right? And she'd been paid, $7, $8, $9 million over that time to do so. And still had bought very, very few shares with non-grant, with her own money, non-granted shares. She had quite a few of them. So she had a horrendous track record. She had kind of only managed to maintain her position through the good graces of the lackadaisical Australian market, to put it mildly. And she had no place running this company. And I kind of called for 1, her removal, board reconstitution, abandonment of all exploration. They had no pedigree in doing it. Wind down of all non-earnout operations, essentially, payout of all the dividend, buybacks, this kind of thing. And the stock went from, 55, 60 to 75, 80, 70, 75. It's still a big discount, huge discount. But at any time along the way, you could have deployed... I'll be frank, there's a disclosed shareholder on the register now who owns 12% of the company who is someone I know and I kind of introduced to the trade. And yeah, it took them a year, but they deployed, multiple millions of dollars into stocks. The point is, it's not liquid, but it's not $5 a day kind of trading, So he deployed a, $7-8 million position or whatever over 12 months. And now the stock's at, they paid out a huge special div. So dividend adjusted, it's trading at 88 cents.
Oh, nice.
89 cents. Even though it's obviously taken longer than I thought, it's taken longer than I thought and been more painful than I thought. But my point is, look, these kind of things, they're thick on the ground over here. So I am kind of spending more of my time, much more of my time looking at things not only that are very cheap, but where I think it's actionable, right? Where I'm very confident I can get the value out, right? It's not just about finding the cheapness. It's what is my plan of action to get that cheapness from being some hypothetical kind of ephemeral cheapness floating around in the air like so much vapor or whatever and into my pocket.
Yeah.
Because that delta is the key. That delta is everything. There's so much stuff that is ostensibly cheap, or not even ostensibly, that is cheap. There's no debate that it's cheap or even very cheap. But how am I going to get that cheapness into my pocket? That's essentially all I think about these days. Much less time on business analysis. And the reason I spend much less time on business analysis, one, I don't even know if I'm that good at it. But also, I don't think that's where the value is, at least as I am a practitioner in the markets, right? Like figuring out is 15 times the right multiple, 10 times, 20 times. That's not necessarily my game. That's a very tough game. Some people are very good at it. But figuring out what is going to change in either the market's perception of the value, like there's a latent cash balance or some asset, understanding what it will take to get that asset sold or valued properly or whatever. It doesn't necessarily have to be sold all the time. Understanding what the market is looking for to revalue the equity to something more reasonable. That's honestly what I spend like 90% of my time thinking about. That and downside, obviously. I mean, downside is part of it. But in terms of actually catalyzing and crystallizing value, that's almost what I'm trying to do, either actively, as in I'm going to try and be the straw that stirs the drink, to quote Reggie Jackson, or I'm going to figure out how to get someone else to get the money out so I can get paid.
Yeah. Interesting. How has it gone for you? Are you drinking coffee right now or Pepto-Bismol?
I got to show you this. This is not planned. This is purely coincidental. I have my Raper Capital
I like
mug.
It. There you go.
Yeah, it's coffee.
Good.
How's it going? So, look, it's been very good. Look, nothing's perfect. Obviously, there have been, this far example I mentioned, it's obviously taken a good 12, 15 months longer than I hoped. But even on that longer time frame, what I would call not just the absolute return on investment or absolute IRR generated by the investment, but the risk-adjusted return on investment. So it's one thing to be locked up in something and not make any money. That's not great, but if all along you're not really risking your capital, you consider you're not risking your capital, it's much more palatable to me than making a very risky return and having that be, a market return or even a higher market return, right? So that's kind of my allegiance to the deep value school. Number one, don't lose money. So when I entered that fire trade, for example, I thought it's basically, if I could remove management, which happened, that happened very quickly, okay? So removing the problematic management and installing someone who is much more sympathetic happened within a month or 2 months. And that massively de-risked the investment.
Did you do background calls on whether or not like other shareholders' appetite were to remove the management, right? Like,
absolutely.
Yeah.
Absolutely. Yeah. I mean, I'm happy to go and be the kind of big guy with the big stick publicly or whatever, but yeah, you need to, it always helps when you're all rowing in the same direction, right? Like I've been involved in other ones where it's a little trickier, where you kind of have a big stick and you want to go in a certain direction. But I mean, I'm involved in one right now, actually. I'm happy to talk about it. It's not like private or anything, but I'm involved in Alto Ingredients, which is a US name.
Oh yeah?
ALTO. Yeah. It's an ethanol play. So I have a big position there, and I wrote a letter to the board, and yeah, I've had some discussion with them, and there's a rather vocal, and to be fair, a larger shareholder than myself on Twitter who has a very different perspective on what the business is worth and what its assets are worth. So, I mean, not to go too off topic, but just to kind of give you an idea of one that worked out and one that may or may not. It's in process, but it's much more difficult than the FAR one, which kind of at least went my way kind of quickly, right? So I wrote a letter, I want to say 5 months ago. Basically, Alto is a collection of ethanol production facilities. At this point, about 65% pure ethanol, a third kind of value-added and special ingredients. Ethanol is a very bad business, historically highly cyclical. You have a problem because a lot of the production of ethanol in the United States is coming out of the farm cooperatives, either owned by the farmers. So it's essentially almost like a loss leader, or historically was a loss leader for corn farmers. So it doesn't exist to make money selling ethanol into the fuel market, which is the main market for main market for ethanol as a product, right? It exists to buy corn. So you have kind of overcapacity. Historically, you have a lot of overcapacity in the United States, which was only really relieved by the export market. But then Trump came in, raised massive tariffs on a bunch of Chinese stuff, and China stopped taking US ethanol. So it almost closed the Chinese ethanol. China's net short ethanol, okay? So that kind of distorted the market, after the Trump election, so pre-COVID. Then COVID happened. You got this massive one-time boost because ethanol is used in, one of the secondary uses is hand sanitizer, right? It's alcohol, essentially. So the price of hand sanitizer went up 10x, right? So all these ethanol guys were printing money for 2 or 3 quarters, and that collapsed. And so you have basically a prototypical, very cyclical, very volatile industry with high cost of capital and high capital requirements. So it's not a good industry to be in. If you pull up the chart of Alto over the last 10 years, you'll see it's down like 95%. It formerly was known as Pacific Ethanol. So a lot of people know Pacific Ethanol. A lot of people know Green Plains, GPRE.
Yeah.
Which is a much different story, kind of soured a bit recently, but had transformed their business from being mostly a commodity ethanol business to a higher value-added products, food ingredients business, okay? So Alto is saying they want to go on this journey and honestly making some investments to go on this journey, converting kind of commodity-grade ethanol production to higher value-added production and spending a lot of money doing it. Not massively levered, but also not unlevered, okay? So the stock got brutalized at the end of last year when they reported some abysmal numbers, ethanol spreads. So the crush margin, the difference between the price of ethanol and the price of corn, essentially, absolutely collapsed, went negative for a couple of quarters. We don't need to go into that.
This looks like March of 2023,
yeah,
it looks like.
So basically they reported the 4Q numbers and the bottom fell out of the stock, right? So it went from $3, whatever, to $1.30, $1.40 or something.
Yep.
So I'm looking at it and I talk to a lot of smart guys who follow the space and, I don't know too much about ethanol, but what's interesting is the replacement cost of these assets. At that point, it was trading at like 40 cents a gallon replacement cost for their assets. And even though they have some crappy assets, they do have some very good assets, fully invested, integrated facilities in Illinois. And what makes them quite good is, firstly, they're fully invested. They're wet mills, so it's a lower cost of production than a dry mill. And they are producing this more value-added products than pure vanilla ethanol. But also it's more the location, because where they're located in Pekin, Illinois is very, very close to some of the best geological formations in the Midwest. So they basically sit above these caves that can be used to store carbon dioxide. So because of I'm sure you followed the Inflation Reduction Act.
Yes.
It's like a freebie goodie bag for environmentalists everywhere. It was like, it was buy one, get one free at ESG land, right?
Still is.
That piece of it. Apparently.
Yeah.
But no, anyway, so the government beefed up the incentives you get for storing carbon capture and sequestration is the technical term, okay? So then that set off this massive gold rush for carbon storage plays, okay? Now, what do you need to be a good carbon storage play? I'm not an expert in the chemistry, but there's 2 basic ways to store carbon. One is, or capture carbon and then store it. One is direct air capture, which is stupid expensive and no one's really done it economically. No one. And it's like the most idiotic thing in the world, right? You're kind of going to apply huge amounts of pressure to the air to suck the carbon dioxide out of it and then store it because that's good for the environment, okay? That's not what we're doing here. What we're doing is essentially just putting something in the tailpipe of an existing ethanol refinery to capture the carbon dioxide that is already spewed out at 99% purity as a byproduct of the fermentation process in creating ethanol. Almost pure carbon dioxide comes out the exhaust pipe. No one ever thought to capture it before. US government's now paying you a massive amount to capture it. If you can capture it, sequester it, and store it in caves that they have to judge will last 1,000 years. That's kind of one of the ways to think about it. So what do you need? You need really good caves, okay? You need it to be very close to your refinery because, as you can imagine, transportation is a huge element. Like if you have some random ethanol facility in the middle of Wyoming, okay, and you got to pipe it thousands of miles to the store, it's not going to work, which is a problem facing a lot of these Corn Belt-related ethanol refineries with their stranded assets, essentially. But this is not the case. So Pekin, Illinois, where they have their main campus, is like 90 miles as the crow flies from Decatur, Illinois. You must know this area. You're from Chicago, right? It's not too far.
Yeah, well, when you live in Chicago, you don't really go to these places all that often.
Well, it's Illinois, okay? So it's
I am
Archer
aware of these
Daniels.
towns. I have driven through
You've
them.
heard the names.
Yes.
You've driven past them. You've unrolled your window and you've thrown your chewing gum out on the sidewalk in some of these towns, right?
I do not do that. I don't litter and I don't throw out chewing gum. But yes, that would be the amount of time that I would spend.
Well, look, the point is they're in the same neck of the woods as not only perfectly formed geologic formations that could capture carbon, but where actually Archer Daniels Midland is already storing shitloads of carbon. In fact, one of the largest and maybe I need to double check, it might be the oldest active carbon sequestration sites is literally like 95 miles as the crow flies from this place. So it's perfectly situated as a carbon play. Now, this is all kind of background. I don't know how interested your listeners are, but the whole thesis that I had and have is you have a, quite frankly, incompetent or let's say historically massively underperforming management team, okay? A set of assets trading at a fraction of replacement cost with a new tailwind for the broader industry, right? The whole ethanol market has been tightening. Now, so I mentioned that the financial performance was horrendous, 9 months ago. Financial performance last quarter was pretty good, and this quarter will be excellent because spreads have tightened. Spreads have expanded, meaning the crush margin on ethanol has expanded, the price of ethanol has gone up, the price of corn has come down. There's a lot of idiosyncratic factors involved, but one of the key is this idea that ethanol is going to be massively tightened in terms of its natural supply and demand because a lot of these ethanol assets are being repurposed to be carbon assets or are being repurposed to be, renewable diesel, sustainable aviation fuel assets. And so it's taking out ethanol capacity from an oversupplied market, essentially. So the market's doing a lot better because people are seeing the kind of free money fund that the US government is offering as an additional and very juicy source of revenues on already invested assets. Now, when you can combine that with assets that were at that time were trading at a tiny fraction of replacement cost, right? If you want to build a new ethanol refinery in the United States today, even assuming you could get the permitting and even assuming it wouldn't take you 5 years to build it or however long it takes, it's going to cost you $2 a gallon, maybe more. At the time I bought the stock, it was trading at 40 cents, 45 cents a gallon, like below the kind of lowest bottom of the barrel, worst quality asset, third party market traded price. So the price is up since then. But I mean, it still trades at a big discount to replacement cost, let alone this theoretical, added value from transforming the assets. But going back to why I raised this whole point, along the way, I've encountered a few fellow travelers, but a lot of guys who, they're religious believers in this kind of this ethanol to sustainable aviation fuel, ethanol to carbon capture transformation. Like I got into this thing at $1.40, $1.50 because replacement value is $6. Okay. And my goal still is, but you guys can't manage the assets. You're slightly levered. It's a very volatile industry. You're too small. You can't do this transformation on your own, and you need to move fast because legislation is changing and evolving, right? You need to invest to capture these gains, right? There's a clock on when you need to put this stuff in the ground by, right? So time is important. So I kind of wrote this long letter. It's on my website. It's out there. Everyone can read it. And I said, look, if you sell to a third party now, you can sell your crappy assets at a discount price, whatever, just the low level that I kind of mentioned, 40, 50 cents a gallon. It's a very low price, but whatever, you can trade there. And then your main peak in campus has real value to someone who wants to pursue the carbon opportunity properly capitalized, focused, not distracted by all this other noise. Like they have about 15 different other projects they're trying to do. And my point is the carbon capture opportunity is the most bankable one because you have these strategic advantages, locational advantages that cannot be replicated. Okay. So that was my point. And I was like, look, stock's at $1.50, maybe it was $2 by that time. You could get six to seven, maybe more, right? This stock hasn't traded at 6 in, 3-4 years. And the register's turned over, by the way. So the vast majority of your shareholders, I think, would support this kind of get the replacement value of the assets as opposed to some, home run type bet on the future of all these other disparate options that you're pursuing. So that was my thesis. That is my thesis. But along the way, it turns out some other investors are telling management it's worth $20. Now, management doesn't really own much stock. Former CEO owned a bit of stock, to be fair, but he retired. I think he owned like 3-4% of the company. But he retired. current management, I mean, they own a little bit of stock, but look, look, it's not really my place or my way to go and, denigrate sitting management teams of stocks that I am currently involved in. So I won't do that. But yeah, they're being told different things from other shareholders, let's say.
Yeah.
And they don't necessarily want to go in my direction at this stage. So at that point, what do you have? Something where there's a lot of latent value if you can actually transact or if you can kind of run it as you see fit. But otherwise, it's still the ethanol market and interest rates are going up and they're capital constrained. I mean, they have debt and they eminently are not kind of, their stock price isn't trading at 3-4 times replacement value. They don't have a cheap equity currency to fund this stuff. So they're a price taker, not a price maker. Is that where you want to be if they're not going to try and maximize value? I mean, these are tough questions. So that's one where, it's proving a little bit more tricky at the moment, and kind of I'm learning as I go.
Well, thank you for sharing that. It's easy to come on and only talk about the good ones.
I mean, don't get me wrong. I'm still up like 2x or whatever, 2.5x.
Yeah,
so
but
I wouldn't call it a disaster.
Okay, noted. It's easy to talk about the easy wins, I guess, right? The ones that are not as, and I understand you're making money, but interesting. That is something that I would outsource to you. I don't think I would want to do that myself.
Well, look, it's funny because the very first kind of one that I got involved in, where I decided to kind of go quote unquote public activist. Okay, so I never really had this goal to become kind of an active. Even this word activist, I don't even know what that means. I don't necessarily like that word. Like, what am I getting active on? I'm just a shareholder, just explaining how I think management would be best served to maximize value. You know what I mean? Like, I had no intention to kind of take this mantle on and become kind of a public voice crusading for value maximization or better whatever it is. But this kind of opportunity showed itself to me a couple of years ago with the whole Hunter Douglas situation, where frankly it worked out way better than anyone could have ever hoped or expected. Almost kind of a miraculous type outcome, where it had no right to, by rights, right? Because I don't know if you're familiar with Hunter Douglas.
I am aware of the brand. I am not aware of the situation.
Yeah, well, so Hunter Douglas was a listed company in Holland on the Euronext Amsterdam. Not a small company, by the way. It was like a multi-billion-dollar market cap, but it was a controlled company. So the founding family, the Sonnenberg family, owned 87% of it. And over a very long period of time, they had been creeping up. They must have floated at 50, 60 years ago and were always the majority owner. But over the last decade or so, they did a few things to increase their hold on the minorities. They reincorporated the business in Curaçao. That's the Caribbean. It's a Holland territory in the Caribbean, okay? The Dutch Antilles, it's called. They reincorporated the business there for reasons we'll cover shortly. And they kind of crept up the register. They made 1 or 2 offers to kind of take out the minorities. So then 2021 comes along, massive boom in building products. So Hunter Douglas makes window coverings, right? The world leader in window coverings. Huge boom, as you know, in new home construction and renovations. So their P&L just absolutely rips. But they're a controlled company. They don't have the best reporting. They kind of lag. So the stocks, and it's not liquid, right? It was trading at like 2 times EBITDA, 2.5 times EBITDA, 3 times EBITDA, even though the business is inflecting, because they own 87% of it, and it trades $1 million a day or something, historically, maybe slightly more for a $3 billion company or something. And so no one's really paying attention. It's listed on a sleepy exchange, Holland. Even though the business reports in US dollars and is overwhelmingly, and it's a global business, but huge market share in North America and Western Europe, the 2 main markets, but it's a global business. And they're crushing it coming through and out of COVID. They're crushing it, but they don't really report the extent to which they're crushing it except on a lag. So then the majority owner senses his moment, right? So he comes in and he offers, 62, 63 euro a share when the stock was like 50 euro or whatever, 48 euro. It's like some nominal 25% premium or 30% premium. Board approved deal, take it or leave it kind of thing. Fairness opinion, all the typical kind of ways they screw you. And, I didn't find this idea. I wasn't involved in the stock. One of my friends told me about it. And I'm just reading through the valuation, right? Reading through kind of the fairness opinion. And it's like, it's hilarious, right? The bank they get to do the fairness opinion is like Sonnenberg's house banker, okay? All the guys on the board, like there are 5 other guys on the board, and like only one of them has another board commitment. Like you can see there are other boards. It's a typical kind of, you've seen it a million times, right? Like it's a cooked and bought. And this thing has been bought and paid for 5 times over by the time it makes it to the market, right?
Yeah.
And then, they cynically time the deal just before they have to report the latest quarterly numbers, which demonstrate the business is just absolutely crushing it. And, so they're trying to buy this thing at like 3 times EBITDA, and literally every other comp trades like 10 times EBITDA. We're not talking 1 or 2 turns here. It's just blatant robbery, okay? So then I'm looking at this thing, I'm thinking, well, okay, this is a robbery. They've just offered your typical 25% premium, but it's a controlled company, okay? So there's no real reason, there's no chance that you can ever really get true quote unquote fair value because they don't have to pay for control. And more than that, the technicals around it were tricky because in Curacao, the squeeze-out threshold is 90%. Squeeze-out meaning, for people who aren't aware, the level at which they can compulsorily acquire all the other minority shares, which is a protection for minorities because the higher the squeeze-out threshold, the more noise you can make before they forcibly buy your shares. The squeeze-out threshold in Curacao was 90%, whereas in Holland it was 95%. So they were already at like 87 point something percent. So all they needed was some small idiots to just give up on it. And they'd theoretically be able to squeeze you out under Curacao law, although again, there was a complication that had never been tested because under Curacao law, you also have the right to appeal to a judge against kind of like a dissent right. You have a kind of like a dissent right to go to the court in Curacao. So I actually talked to a lot of much larger shareholders, and we hired Curacao counsel. Sorry, I should say they hired Curacao counsel. I just free rode on it.
Yeah.
And they kind of, we went through it, and they were willing to go to Curacao, the courts in Curacao, and basically drag this thing out. That's how bad this expropriation was. So I said, look, there's a better way to do this. We're just going to shame it. Let's shame these MFers, okay? Like this is a blatant robbery. Let's call it what it is. Let's put it in the Dutch press. So I managed to get in touch with the Dutch press. Actually, I have a deal tombstone over on my shelf that someone made where they printed out an article where they wrote about me in the Dutch press. It's all in Dutch. And I used some colorful language in the letter. And I basically said, look, this deal, if it is allowed to go ahead, will be the greatest expropriation of value by a Dutchman since Peter Minuit bought the island of Manhattan for 50 guilders in 1636. And they quoted that in the Dutch. They quoted that in the newspaper, or they said something like Jeremy Raper's telling the main shareholders, giving the middle finger to everyone else. And they wrote in Dutch, they're like, Jeremy Raper had ein Mittelfinger to the... It was great. It was brilliant. I didn't know middle finger was middle finger in Dutch. Anyway, so they raised the deal, obviously. They raised it to like €80 or something. They raised it like 20%. Yeah, I mean, they raised it from €60 to 80, €82, and at the same time, the fair value of the equity had gone from €100 to €150, right? Because keep in mind, 1 or 2 quarters later, the earnings just absolutely exploded, right? So it actually got cheaper. They raised it to 80 and it was a low multiple. Maybe it went from 4 times EBITDA to 3 times EBITDA. So I wrote another letter. So like, guys, you don't get it. Like last time I wrote the letter, I said fair value was like €120. Now the fair value is €150. Okay. So actively I've lost value here because you're giving me an extra 15, €18 and the fair value's gone up €40 or whatever it was, So then they conducted the deal, but what did they do? They didn't end up squeezing you out, which was interesting. I think they theoretically could have or tried to, but they didn't enact the squeeze out provision. Now that was the real kind of weird thing in the whole scenario. I don't know if they were scared about going to court in Curacao, which they would have had to do, or more likely there's a nefarious explanation, which I'll shortly cover. But they went from 87% to like 92% or something. So theoretically they thought they could have squeezed you out, but they didn't. They said, we're just going to leave the other 8%. So then like literally 3 months go by, not that long, 3-4 months, nothing happened. And at that time, I kind of publicly said, look, everyone who wanted to sell this thing at any level below 85 just sold it. right? Fair value is so much higher here. Like, this is the time you want to be loading the boat, right? Like, yeah, you might have to wait a year because in Dutch securities law, you have to wait a year between offers, right? So I said, you might have to wait a year, but I mean, fair value is like 150, whatever it was. Yes, I said this on Twitter, And then 3 months later, December 30th, December 31st, 2021. Yeah, end of 2021. It wasn't long. It was like 3 months later and maybe 6 months after the first offer. 6 months after the first board-approved bid at 63 euro a share. They sold the entire thing to a third party at 175 euro. I shit you not. So they basically... So, and then I found out later on, I mentioned this on another podcast, that the family, the main shareholder, the Sion of the family, not the Sion, the legacy main guy who's very old, lives in Westchester, New York. Okay, he's Dutch American, but his business is listed in Holland, but he spends most of his time in New York. I mean, one of these global captains of industry. He lives in Westchester in the same neighborhood as the buyer, 3G Capital. Bought this business. So look, I have no evidence to support this, but given the play-by-play and how it went down, it's reasonable to conclude he was playing at the country club with his 3G buddy. He's like, yeah, he's old, he's retiring, he's doing his tax planning, whatever. He's like looking for an exit. They have a conversation and/or an agreement. He's like, you know what? I'm just going to buy it from the minorities and squeeze an extra $600 million out, or whatever it was. And that was his plan. Like, he had a pocketed bid from a third party that it was always his plan to sell. And he was just going to rape his minorities while he was doing it. But that was the original plan. In the end, the minorities got 175, or the ones that didn't sell. And so, as I said, that was kind of a home run, miraculous outcome that I had no right to, because it was a controlled company all along. And I think I learned the wrong lessons from that, meaning I thought that you have these situations where you make a plaintive enough argument in the public domain, doesn't matter what the ownership structure is, you make enough noise, they're going to come to you. That actually was not the right lesson. It was the exact opposite. So, because I got involved in a few other ones in Indonesia or whatever, where you had a similar situation as a majority owner taking out the minorities, and you couldn't apply the same kind of pressure, or they just didn't care. So that was exceptional in more ways than one. But that kind of also opened my eyes as to the possibilities around this kind of what I call social activism. This idea that even if you're not Bill Ackman or David Einhorn or Dan Loeb or Nelson Peltz, you don't need to own 5% of the company, 10% of a multi-cap to actually make a difference. Because look, if you are efficient in getting your word out, and if you have something good to say, people will pick up on it on social media. So you can actually speak to a larger portion of the register over time than your own 1 or 2% holding. So, I used to, and FAR, for example, is a good example. I really only had a couple percent of the company, but I could essentially speak to a much larger portion of the register at some point because I was in touch with like-minded fellow travelers, let's say.
Yeah.
And so that kind of opened my eyes to that possibility, and that's something I do a lot more of. But now I'm trying to take it one step further, and that is actually have more bullets in my gun. So not just buy like 1 or 2%, tweet about it, talk about it, write a few angry letters, or engage with the management, but owning 1 or 2%. But now I'm actually trying to venture into this area where I raise SPVs, special purpose vehicles, to acquire meaningful stakes in companies if there's liquidity available, or if there's a block seller or what have you. And then it doesn't become a discussion, or it shouldn't become a discussion. It's basically, look, if I own 20, 25, 30% of the company and I'm the major shareholder and I have a certain agenda, provided the shareholder register is amenable, and provided the board structure is amenable and not staggered, or the rules are amenable, I mean, it becomes less of a discussion, more of a dictation at some point. You know what I mean? Which goes back to my point about focusing on extracting the value. Like, I used to be cool with, if in Hunter Douglas's case, it was cheap enough. It was so cheap, right, that you could still be a minority and live with the risk that, like, at 65 euro, wherever I paid, the worst case was they were going to bump the bid 20% or whatever it was, right? To just get it over the line. So it became a different trade later on. But initially, when you risked that first bit of capital, it was just so cheap that you could take the risk of being a minority in an unfavorable jurisdiction, in an unfavorable corporate structure. That's often not enough for me now, okay? I want to be the majority shareholder or one of the largest voices at the table. And, I'm happy to pay more for that even. Because that's really the only way I see that I can not guarantee, there's no guarantees, but I can maximize my chances of getting the value, as I said, from this ephemeral kind of conceptual value on paper into my pocket or my investors' pockets.
So that's why you want to raise the SPVs.
Yeah. So I raised an SPV recently, and this is live. This is publicly disclosed. I've made the filings, so I'm not going to talk about the strategy or specifically of the company, but I've raised money and have taken entities I manage have taken a 20-something% stake in a listed aircraft leasing company in the UK called Avation, AVAP. This is all public filings. And my goal is to maximize value for all shareholders. It's ostensibly a very cheap equity. And I have a number of ideas to kind of create value for all shareholders. And I think having more bullets in the gun, so to speak, will be beneficial to all shareholders of the company.
You have a history of leasing in that space, if I recall correctly.
Well, actually, I got leasing very, very wrong in COVID. It was one of the reasons why I was kind of almost on my knees during COVID, the first part of COVID, because I had an overweight position in Aircap, which obviously went tits up very quickly. I've said this before. It's very rare in this business. It's very rare you'll be forced. In Texas Hold'em poker, there's that famous quote in Rounders where he says, what does he say? He says, the key in Texas Hold'em is to force your opponent to make a decision for all his chips.
Yes.
Right?
Yes.
It's rare to think about that in the context of investing, but it does happen, and it's scary. So I would say that in COVID, if you remember correctly, I'm sure you do because you're a market practitioner, you had 2 weeks. You had a 2-week period where you had to make a decision for all your chips. Okay? Meaning the price was moving so fast in a lot of these, anything touching travel, anything touching movement, okay? The price was moving so fast. You literally had a period of days, not weeks, not a month, not a quarter, days to decide, is this equity impaired or not? Very, very difficult, very scary, actually. I remember I had a conversation with one of my friends here in Tokyo. I was visiting Tokyo at the time, living in London, visiting Tokyo, 2 young kids.
Told you to get out, right?
Horrendous. Yes. So I go to lunch with this guy, and he's on the front lines. He's like running a bank, running the equities desk of a bank. Things are blowing up. S&P was literally gapping down 10% a day, right? Maybe you had the odd day. Every fourth day it would go up 5% because Trump said something idiotic, I remember. Like, it's all fine. And then on day 5 it would go down 10% again. And that happened for, it wasn't actually that long. I mean, it's 15 trading sessions in a row. You had this absolute pandemonium. Anyway, so during one of these days, basically the bottom, either the bottom or 2-3 days, I went and had lunch with my friend. I'm down like bad. I'm down like 65%, 60% on the year. I'd just been doing this for a couple of years full-time from my last hedge fund gig. Didn't have a lot of money. I was looking down the barrel, having to go back to, if things didn't bounce back, I was looking on the barrel, having to get a job, God forbid, and go back to work for someone else. Not really my style. So I was kind of down and out, so to speak. And I sat there and I said, I'll leave his name out of it because just for safety. But he looked at me and he said, Jeremy, get out. You have to get out. This is the apocalypse. Like, he literally went to his Japanese bank and withdrew all his yen in cash.
Wow.
Like $1 million of yen in cash. He had this massive suitcase full of yen, and he was moving it from his bank to another bank because his bank was the shitty local bank that paid a tiny bit more interest, and he was moving it to Nomura or something. I mean, he's a foreigner, but he was a yield chaser or whatever, and he was moving. He's like, I gotta move it to a safe. And I said, dude, like, I literally looked him in the face and I said, you may well be right. You may well be right. This is the apocalypse. But if I sell all my shit now and it's not the apocalypse at these prices, oh, I'm screwed. You know what I mean? It's almost
Yeah.
like it was so priced in, right? And by the way, I did sell a lot of stuff. Obviously, I took a lot of pain, but I managed to rotate it into stuff that was, more attractive or more levered to the rebound or whatever it was. And so I actually had a great year in 2020, which is a great lesson actually for anyone that's kind of down and out, because in March 2020, I was down at least 60%, maybe 65 at the lows. And I ended up 2020 up 75%.
Wow.
So it was like almost a 10x growth in my account from low to high that I measured. Now, don't get me wrong, we're not talking $100 million here. We're
No,
talking
I
very small
understand,
numbers.
but dude, it would have been easy for you to blow out at the bottom there, and you stuck to your guns and you bet, and it paid off, and that's good.
Yeah, I mean,
It's what's supposed to happen when you bet and you're right.
Yeah, I mean, on individual security calls.
Because I remember you talking about that.
Yeah.
I remember you talking about that, and you said if I sell now, I'm selling at a discount to replacement value, and or
liquidation.
not yes, liquidation. That's right,
price.
Liquidation. Yes, and like I can't do that.
Yeah, but so the point was, I did actually lose a lot of money on Aircap though, because one, my entry price was much, much higher. And of course, I didn't ride it all the way back. I did take the losses. I mean, so yeah, I didn't sell at $12 a share, but I sold a bunch at 20. I sold some more at 25. I sold some more at 30, And yeah, that capital, don't get me wrong, that capital got redeployed into other stuff that did better. So I'm not complaining, but I definitely, what I'm trying to say is I'm not like some aircraft leasing savant.
I'm just saying you're aware of it.
A lot of money in the past.
Yeah.
I thought you said I was the expert on all things. That's what I heard.
Well, obviously, that's why you're on a podcast with me. But no, I know that you've had a history of following that space.
Right.
What's your view now, years out? What's your view of the GE deal now, years out?
Dude, so it's funny. I think the last time we chatted on it, I said some really bearish things about that deal. Or also, there's a huge amount of context that people need to understand, right? Like the last time we chatted was right in the teeth of the COVID aftermath. Okay, so Aircap, a business I know pretty well, had made this whole song and dance about being these great underwriters of credit. Okay, no one understands credit like Aircap. And being great at selecting counterparties. Then they went through COVID, and what happened in the first 3 months of COVID? Basically, 3 or 4 of the largest bankruptcies, they were disproportionately hit. Air Lease, their number one, one of their larger competitors on the public space, was unscathed. So Norwegian blew up immediately. LATAM blew up immediately. There's got to be 2 or 3 other ones that I even forget. But no, I mean, their underwriting of credit risk was disastrous. And I'm not even sure it's the fault of their credit department. It's just that when you're that big, this is what I learned. When you're that big and you have 1,000, 2,000 planes, you don't pick your clients, they pick you. Like you have to deploy the assets, right? Mm-hmm. If you're trying to maintain your fleet and or grow, they pick you. So like you almost have to lease to, if not everybody, then almost everybody. So it's like, it's not really a critique of their credit department so much as the business model or the size of the entity. So that was front of mind in, early 2021 when we spoke, or whenever it was. That had just happened. That had just been going on. And by the way, they managed the business quite conservatively on the balance sheet side. Like they were never overly levered for these businesses, for a financing business, right? But their whole kind of investment pitch to the market was, we're these great underwriters of credit. We've never experienced a loss greater than X% on any given counterparty. We're really good at repossessing assets, whatever. Some of those points kind of fell by the wayside, honestly, during COVID. Now, I'm not going to say I've come full view, but I have kept up on the company, and what they've done recently has been absolutely incredible. Like, I literally just the other day, I read their latest report, their quarterly report. They crushed it. It's been a long time since I've seen a quarterly report this good across companies in terms of outperformance in the quarter, what they said about the market, their positioning versus others, and what they're, walking the walk, so to speak.
What about their positioning is interesting?
Well, they're uniquely positioned in that, there's a huge supply-demand imbalance in the global passenger aircraft market right now.
Turns out if the COVID shutdowns mess up your entire supply chain in aerospace, shortages occur.
Exactly. Exactly. Putting it simply, new planes are just not getting built. Well, they're not getting built on the schedule that the OEMs thought they could build. And even the ones that are in service, the MROs are massively backed up. Okay, so when you take a plane out of service and it needs to go to the shop for maintenance, MRO is maintenance, repair, and what's the O stand for?
I thought it was a maintenance repair organization, but I could be totally wrong on that.
That could be it. You take the plane out of the air and it goes to the shop. That used to be a 60-day process, whatever it is. That's 2, 3, 4x that now, right? They can't get parts. They can't get labor. Same story, basically, no matter where you look. And
it's overhaul. Sorry, maintenance, repair, and overhaul.
Okay,
silly me.
Another word for maintenance, basically.
Yes, that's right. And repair, kind of.
Maintenance, and maintenance.
That's right. But yeah, 3M was taken. Yeah, so
3M was taken. Yeah. So look, they're in this fortunate position of having the largest global fleet with the most options. Not just by a factor of their size, they actually made the decision to step into a lot of orders in 2020. One thing I also did not appreciate at all at the time. So they stepped into a decent order book position, not quite in the teeth of the crisis, but almost, and basically made a bet that they could take delivery on planes, near-term deliveries, that would be now very, very desirable, right? So I actually don't understand why the stock is trading where it is. Like, I should probably go out and buy some. I haven't owned it since COVID, right? I have this huge scarred tissue there, but they literally go on the call and they say, we sold assets in the fall. And by the way, a lot of assets, not just like 1 or 2 planes. Like they sold 600 million worth of assets.
Yeah, what, like a 24% gain?
Yeah, 24% gain on gross. On a levered basis, that's 2 times book equity. The book and the net book, the net to tangible book today is like 80 cents on the dollar in the market, right? So he's like, look, I sold it at 25% gain on sale on a gross basis. Historical average the last 10, 15 years is 8 to 10%. So typically sell assets at 1.1 times gross. They're selling them now at 1.25 times gross. That translates into 2 times book equity versus historical 1.3 times book equity. So a huge premium because people need planes. People need planes, and airlines are actually proactively going to their lessors and saying, I want to buy in these aircraft. Or they're extending the lease. So that's the other key takeaway from the call, which about the positioning. 80 to 90% of leases, 90% of wide body renewals that are coming up are being extended. I haven't seen numbers like that in the last 6 or 7 years. Wide bodies have been chronically oversupplied pre-COVID. Wide body planes, much trickier value proposition because obviously they're larger, they have more limited uses, they're only used on long haul routes, they can only be used at certain airports. A lot of older, some wide bodies, they actually cannot land at certain gates, whatever, because they have the wrong configuration of doors. Like double-decker planes, you don't see them that much anymore because it's very difficult to actually, from a traffic perspective, where do you actually park them? You need certain very sophisticated airport gates with like double-decker walkways, you know what I mean, that not many airports actually have. So this is the reason why kind of like the 747 or even some of the newer Airbus, I think it's the A360 or the A350.
What, the 380 is what died?
I'm trying to think of the double-decker one.
I think that was the 380.
Yeah. Well,
that thing was freaking massive. It couldn't like land at certain areas because the runways weren't long enough.
They're unwieldy. They're very unwieldy. So like the wide body market historically had been very, very more volatile, less dependable, and oversupplied, frankly. And now it's like actually crushing. I mean, temporarily the demand is off the chain because airlines want to lock in lift. They have to lock in lift. And so look, obviously this is
what happened with the wide bodies? I don't fully understand because I thought that one of the risks to wide body is I thought the story in like 2019 was that the 737 and the A330 were going to be adequate, or A320 were going to be adequate to handle like, New York to London, right? And that's a flight that's typically wide body, but turns out that's not what ended up happening or hasn't happened yet.
Remember, the 737 MAX has been chronic issues that go back before COVID with quality. So that whole delivery schedule is 4 or 5 years delayed, essentially. So, and also a lot of those orders got cancelled. So in the process of fixing the 737 MAX issues, a lot of airlines just killed their orders and are then now relying on either wide bodies or other narrow bodies. But you have a combination of things. 1, 737 MAX issues. 2, general maintenance issues. 3, supply chain issues. And 4, massive rebound in travel. So actually international travel has come back pretty strong at kind of this bad moment for for a lot of the airlines in terms of capacity. But yeah, so look, the business is doing very well. I mean, I'm not saying it's going to continue ad infinitum, but yeah, they're crushing it. They're being very clear on their capital allocation priorities. If the GE stake was not still in there, so they've gone from 45% to 15%. Aircap repurchased, I think, 19% of the shares outstanding at the beginning of the year in the last 10 months.
Yeah, that's crazy.
Pretty good. Yeah, so I mean, no one wants this business. It's been a publicly listed business for 10 years, more, 20 years. And, when was the last time the equity traded above book value? It's got to be a decade ago. I mean, I've been moaning about that for over a decade. So it's like, it fits perfectly into David Einhorn's bucket of where, I mean, by the way, this isn't some shitty small cap situation that I moan about, right? This is, what is it? This is a close enough to $7-8 billion company now, market cap wise, with a $15 billion, it's $12-13 billion book value, I want to say. I'm shooting, I need to look up the numbers, so I could be way off, but
I don't think you're way off. Maybe $1 billion here or there, but what's $1 billion among friends?
Exactly.
Let's see.
It's eminently tradable, eminently liquid, eminently investable for anyone on the planet in size. And
12
yet
billion
it
market
trades where
cap.
it does.
12.6.
12. Okay. So 12 against a $16 billion book value, right? Yeah, and about 40 billion of assets, or under 40 billion of assets. That makes sense. Okay, so yeah, I mean, it's one of those things where, if a tree falls in the forest and no one hears it, did it happen? So look, market's been weak lately.
2022, 69.7 billion of gross assets.
69 bill?
That's 1231.
Okay.
Gross. Well, yeah,
but
it's total
not
assets.
that much lower now. Wow, they really did buy a lot of planes.
Yeah, that's wild.
It's funny. The other thing with the GCAS deal is they went into all these other verticals that they said were shitty. That's the other thing why I was anti the deal. So it's like they said, we'll never get into helicopters. Helicopters are a horrendous market. It is. We'll never get into freighters. Freighters sucks. It is. But I mean, whatever. But at the margin, it doesn't matter because those are tiny relative to the rest of the asset pool. Something, again, I underappreciated.
Yeah.
So yeah, they're doing very well. But I mean, it is the haves and the have-nots, right? Like, they're still funding. Their net spread went up, meaning the difference between the average lease rate they receive on a yield basis. So if they have 100 of assets in the market and they get 8 a year, that's an average lease yield of 8%. It's much higher than that, but just to explain the math. Their average lease yield minus their cost of financing, that's called their net spread, that went up in the third quarter, despite everything that's going on with interest rates, right? So they're managing to pass on the cost of higher interest rates to their customers. And it's not showing up in credit yet, meaning they can charge, instead of charging 12-13% yields, they're charging 15% or whatever. And they're not having to take huge impairments at all yet. But that's their situation. Like, if you're a smaller lessor with a smaller platform, with less resources, with less bargaining power, less flexibility, like maybe you have to enter into below market leases to maintain your customers, or maybe you entered into below market leases during COVID and those haven't rolled off yet. And now all of a sudden your cost of debt is going up with the interest rate curve. And you're stuck offering, it's kind of like a bank. It's exactly like these banks where they kind of enter into fixed financing relationships on the asset side, but are not as fixed or on the liability side, and the spread's just getting crunched. So it's the haves and the have-nots. The haves and the have-nots. They're crushing it. But a lot of the private guys are not doing so well. There are a couple of guys that actually got restructured recently, but no one would be interested in that. It's off. It's like not public stuff.
Do you have any type of like business quality filter that you will or will not dabble in?
I don't know if I have a quantitative one, maybe a slightly qualitative one, but I'm not interested in business quality in and of itself, okay? It means very little to me. Like all these people spouting off on Twitter about how good a business is, it means nothing to me independent of price. Literally nothing. It's kind of like saying, this is a beautiful Ferrari. Right,
yeah.
But if I have to pay $10 million for a Ferrari, then why are we even talking about it? I mean, we're not in the business of, we're not in an art gallery, right? We're not admiring beauty or quality in its abstract sense. So yeah, I've never been, and I understand that people I mean, they look up to Buffett and how he's pivoted and how he's made quality kind of his touchstone, right? And look, I think people kind of learn the wrong lessons, honestly, in observing a lot of the greats. That's not to say it can't work for a lot of people. I know a lot of people who's only do quality and do very, very well. But me personally, just what appeals to my personality and what I found works for me, filtering for quality has never really been a big part of it.
I think that what I have, I guess the reason that I have tried to implement some sort of quality filter is I found that the earnings are somewhat more predictable, but maybe statistics, like studies, might prove my feeling differently. And certainly the experience that I'm living through in charter might ask me how much I understand quality for real. So that's fun.
What did Howard Marks say? There's no business good enough where at the wrong price it cannot be a statistical loser, and there's no business bad enough where at the right price it cannot be an amazing investment. I mean, that's all it is. It's not quality alone, and it's not price alone. It's price versus quality.
Yeah.
It always has to be the way. That's why I find these people a lot of people, and this is a common way to teach analysts when they're coming up. They'll get sat in a room, they'll be given a company, and they'll be told, don't look at the stock price. So they're not able to look at the stock price, and they'll be asked to value the company and to understand what they think the valuation is. And from a pure intellectual exercise, I understand that's valuable. To understand, kind of your opinion or what you think independent fair value should be. But for an experienced practitioner, that you can't do that. I mean, you have to filter based on price because price is what you pay. So there's no point in doing all the work, and it takes a huge amount of work to get fluent on even a single company, to the extent that you're ready to make an investment or countenance making an investment without reference to price. I mean, that price is everything. Price is everything. If price wasn't everything, we wouldn't be in this game.
Well, I think you're right, but I guess that some of the quality people that I talk to that I think do it well use their understanding of the quality to force rank the odds that they perceive there to be, right? So maybe it provides overconfidence. That's very possible. I don't know.
Yeah, I mean, I don't want to speak too generally. I mean, this is just what works for me. So I'm not trying to have a go at anyone who has a different approach. Not at all. What I would say is that quantitatively speaking, if you have this kind of quality bias, now is probably the worst time to maintain that in the last 20 years, right? I mean, when has quality been more expensive relative to not quality? Isn't this what Cliff Asness is always talking about? I mean, small cap value versus large cap growth.
So Jake Taylor's talking about, so Toby's talking about, yeah.
Yeah, exactly. You guys talk about this a lot. So it's like, on the one hand, great. On the other hand, that's kind of, I don't want to say it's resulting because, hey, if you've done it well enough for the last 20 years, you should have made a shitload of money. But ex ante, would you want to engage in a game where, based on pure factor alone, the factor for which you sub-select as the pool from which to begin to pick is already trading at a 20-year higher, versus on a relative basis versus the other pool?
We're not picking tech, but yeah, I agree. I agree with you.
Yeah, I mean, I wouldn't. Again, that doesn't mean you can't make money.
Yeah.
I think it's hilarious though when people say like everything's priced in, and then like I always give the example of Apple. Apple in 2007 when they released the iPhone, like literally anyone in the entire Western world could have gone into a store, picked up an iPhone, picked up a BlackBerry or a Nokia or whatever it was. Literally anyone. Just play with the phone for an hour, then play with the Nokia for an hour, and then just gone and bought Apple and shorted Nokia. In as much size as anyone could have wanted to have done. But the market, you know what I mean? It's like people always ask me like, what's your edge, or what's your, what special skill set do you have? And I always go back to that Apple example. I'm like, you know what? You just think clearly. There's easy wins out there. There's easy wins out there if you just block and tackle. Yeah, of course. The best surgeon in the world has a couple of tricks up his book over the next other best surgeon, but he's not running from a different playbook. He's just looking at the same playbook and doing it a little bit better, a little bit faster, a little bit more insightful. There's not some secret sauce, you know what I mean? Yeah. So, I mean, that's kind of a rambling answer to your
No, I
quality
like
point,
it.
but I think about that a lot.
Well, I just ask because, you talked about like ethanol and, those can be scary businesses. So I think the price you pay has to be like real fucking cheap.
They're scary businesses, and that affects the entire investment strategy. That is why I'm advocating the course I'm advocating. And
Yeah.
and don't get me wrong, if or when it becomes clear to me that course is not viable, see ya, baby.
Yeah.
I don't stick around to see how if they stick the landing, This goes for
Yeah.
everything. I think like Puppy's quite good at that. Like you have a thesis. That thesis is not like it's definitely not based on quality. Might be based on some fundamental inflection or change in the perception of the equity. In his case, he likes to do this thing where he, again, similar kind of, it doesn't really have to be quality, or oftentimes it's not quality. The junkier the better because you get it cheaper. But irrespective of that, his point is you're going to try and catch a change in the perception of a given asset class or a given equity, a given company or a commodity, whatever. And you can catch that. And as it goes from shitty to less bad to okay, you make multiples.
Yeah.
And guess what? If that doesn't happen, or if there's some counter bit of evidence, see ya. You know what I mean? Like, don't stick around. So, yeah, I mean, these are, we're speaking in general. It's also funny, this thing about investing is like everyone loves to speak about general rules or lessons or what I follow. But the more I learn about investing, the more I learn almost everything is idiosyncratic, at least the way I practice it. That's not to say my skills are not replicable. Not at all. But every situation is quite nuanced and has its own unique characteristics that need to be weighed and examined. So like take this Spirit Airlines situation, okay? I don't know if you're involved in the Spirit JetBlue merger.
Very, very tiny. In my IRA, I have a call spread.
But you're familiar with the strands of the case. Okay, so there is a lot in common with this, with other precedent, not just airline transactions, but other precedent merger litigated DOJ cases. Okay, so I'm sure you've probably heard that the government's case is maybe stronger than a middling case, but post the divestitures looks quite similar in analogous terms to the Assa Abloy Spectrum case that the DOJ also pursued. You've probably heard that analogy drawn.
I have not heard that analogy, but I have looked at what JetBlue has been doing to divest assets, and it actually kind of reminded me of in a way like AB InBev and SAB Miller. I mean, it seems to me that if you're willing to divest of enough, you can usually get these things across the finish line. And they seem willing to do it.
So exactly. So there is a pattern, a historical pattern of kind of merger cases that have been pursued by governments to stop them happening on antitrust grounds. And there's a historical precedent in terms of how you can accomplish that merger. So how you can alleviate the concerns, assuage the concerns of the government. As you suggested, one of the typical ways is through divestiture of assets in markets that are deemed to be too concentrated, too anti-competitive, what have you. We've also have a long discourse of how the current political regime is extremely anti-merger, is kind of going off the reservation with regards to how they pursue and litigate antitrust law. Okay. So what I'm saying is this case exists within the context of all these other kind of cases. You can draw learnings from them. You can maybe not draw conclusions, but you can definitely apply the knowledge you've learned in all these other cases and other kind of airline-related stuff from prior administrations, whatever. So sector-specific stuff to kind of come to a reasoned and logical conclusion. Nevertheless, I would still argue there are so many idiosyncrasies with regards to this specific merger that it's unique. I mean, it's and this is unique, but what I'm trying to say is a lot of these things end up being quite unique. There's 2 or 3 factors that are key to the outcome here that are not really replicated in other cases, right? So for example, I'll take the JetBlue case. JetBlue's trying to acquire a Spirit as of this moment. Hopefully this doesn't age poorly, but it's very rare for a company to proceed to argue a court case to be allowed to do a merger that, if it is consummated on current financial terms, will immediately put JetBlue in severe financial stress. Severe. So like if this merger gets consummated on announced terms right now, JetBlue goes 10x levered, net levered. Okay? Spirit's last report, and by the way, I'm long Spirit stock, okay? This is a fact. Spirit's last report was an absolute abomination of a report. they went negative EBITDA. They said they will definitely be negative. I mean, in a manner of speaking, they said they'll be negative EBITDA in Q4. There's a chance they'll be maybe not negative EBITDA in 2024, but I mean, consensus EBITDA is going to go down 50% for next year, okay? And they're burning cash. Now, there are explanations for what's going on, like 25%, not 20. Yeah, at one point next year, 25% of their fleet will be on the ground because they can't get the geared turbofan inspection issue from Pratt & Whitney done in time. Because Pratt & Whitney, speaking to our earlier discussion, Pratt & Whitney cannot get the shop inspections done. The turnaround is being massively extended on those inspections. So those engines have to stay on the ground. Well, guess what? Those P&W 1100 powered A320 Neos that are in Spirit's fleet, they're their most fuel efficient, lowest cost fleet. Demand is soft, massive discounts. They're forced to run a high cost fleet with huge overhead of keeping a bunch of their planes on the ground all through 2024, probably through 2025 as well, all while demand is falling in the toilet for broader economic reasons. Now, that's not unusual, but the fact that the acquiring party has this strong strategic interest in doing this deal for like a 5, 10, 15, 20-year forward plan, right? That's basically what they've articulated. Yeah. This is like a once-in-a-generation type trade. That is butting up against the financial reality that if this deal closes, the day it closes, they will immediately be highly distressed. Maybe not going concern, because JetBlue has some unencumbered assets and actually JetBlue is doing a lot better, or was doing a lot better than Spirit, but they will become highly distressed. So you have this very complicated situation where JetBlue fought for this transaction aggressively in a different market environment, still believes theoretically everyone believes in the transaction until they don't, but theoretically, as of the most recent statements, pre-trial briefs, very strongly in the industrial logic of this transaction, and is willing to lay it all out there, but they're admittedly paying the wrong price, and they're paying the wrong price to such an extent that it could bankrupt them.
It feels to me a little bit like a CEO that can't walk from a deal, and part of the reason I think he can't walk from the deal is I do think that there are not that many opportunities. Well, I know there are not that many opportunities to acquire that many planes and that many gates at once. I mean, that's just kind of how the industry has shaken out, but it will not surprise me at all if this merger ends up a little bit like the Bud Light SAB Miller merger, but AB InBev rather, which I'm not sure 3G is totally happy with at the end of the day. Well, they had to sell a lot. They had to sell so much to get it done. And then you have then you're a forced seller, right? Like the buyers know why you're selling. Like it doesn't typically, probably takes a while to get through that is maybe the best way to say it. Yeah.
I mean, the logic for them being allowed to merge at this point is basically bulletproof. My view is it's bulletproof. Like you had all these arguments around what they were going to do. Like the government's case was already extremely narrow. To summarize for everyone who's new to it, the government's case was basically 2 points. Okay, one, you cannot be allowed to buy Spirit because Spirit is a unique competitor. They are the OG ultra low cost carrier. There's nothing quite like Spirit. When they enter a market, they bring rock bottom fares. They protect the little guy. They're unbundling. No one can unbundle like Spirit unbundles. Like they clearly have never even flown on Spirit.
Spirit, a lot of customers like Spirit, man. A lot. Just look at the load factors.
They're all stupid. The people that like Spirit are very, very silly, I'm sorry to say. But that aside, the argument is twofold. One, Spirit is unique. You cannot be allowed to take them out because nothing can replicate Spirit's force in the market. That's basically a quote. And then two, there is presumptive anti-competitive overconcentration in a bunch of markets because JetBlue and Spirit overlap on 186 unique origin and destination pairs. 185, 186. Okay? And the presumptive concentration of combining in those key markets, by the way, 185 out of many thousands of routes across the entire nation. But forget that for a second. Okay, we're talking about a subsegment of a few percent of the national market, but forget that. 185 routes, the presumptive concentration goes to unacceptable limits under the law. Those are the 2 points. So the first point we'll deal with in a second. The second point was basically dealt with by JetBlue and would ostensibly be dealt with them at the trial. They say, look, even on the narrowest of narrow definitions, which you don't agree with, but if we just take those origin and destination pairs, of those 180 or whatever, only 51 are actually connecting routes, meaning, 130 odd or whatever are, we're competing on New York to Los Angeles via Chicago, but because Chicago to Los Angeles has all this other traffic on it, we can't be said to be uniquely competitive on that route, okay? But within that 50-ish route subsection, 6 have already churned off due to normal course of business since they actually did the analysis. So these things are dynamic. Routes are changing every day. It's not like there's a one static point in time. So, and then of the remaining 45, 34 will be divested by what they've announced. So if the divestitures close, and there's no reason to suggest they wouldn't close, like not only that, but they're going to other ULCCs as well, by the way. So they're going to exactly the segment of the market that the government theoretically has a problem with. But so of those 180 odd routes, the core competition really only happens on 50. And of those 50, 30 some have been divested, will be divested, and 6 have churned off. We're talking about 10 routes. So normally, I would say, looking at precedent, a judge would look at this and say, why don't you just divest the other 10 routes? Just find someone else to buy them if that's the problem. At which point the government falls back on this other argument. And that's why they argue the divestitures are not enough, which is, no one's as good as Spirit. You see, if you divest these assets to someone other than Spirit, they won't run them as well. They're not as good. They don't have that spirit, joie de vivre, or whatever it is. That's when you say, look, that's when you just say, but Spirit's going out of business. Spirit's going out of business if this deal doesn't go through. Like they literally said, we will have to raise prices. This was in their press release the other day. We will have to raise prices. We have to generate more revenue per seat. And they're dialing back growth. All these things that made Spirit unique are kind of moot at this point.
Well, here's where I have some sympathy for the government case. I think that the ULCCs, the ultra low cost carriers as a segment, have forced basic economy into the market. And I think basic economy is good for choice. And I think that if you remove the fleet of Spirit, even if you cite the backlog of the future ULCCs, I do think you're probably going to have a subscale ULCC market for a while. And that could have some consumer impacts that are not. That's how I would argue it. If I could draft my own argument, that would be the argument. I would have no problem at any level letting Frontier and Spirit merge. I guess I kind of understand the problem of letting Spirit and JetBlue merge, but I also understand that it looks like JetBlue is going to do enough to assuage the concerns.
Well, look, they could also come out and say, cool, we'll guarantee unbundled routes on all our routes. So if it's unbundling or basic economy that you want, we'll just keep basic economy, which, by the way, they already do.
I think they're going to say what they have to say, right? And promise what they have to promise. But I kind of understand the issue here. Because you know what sucks? Sucks is if you're flying on Spirit, you get a delay. They're so underfleeted that your delay takes forever. If removing one major ULCC carrier creates that throughout the market, like the entire market becomes less. But then again, it's not like Frontier and Spirit have a bunch of cross bookings. I don't think they do have common ownership.
But the point you made is actually a point for JetBlue, because they're making the argument the value proposition is not purely based on price. And therefore, if it's the actual delay and the lack of reliability or the delays, the connectivity that you're paying for, then guess what? With a bigger, more national, wider carrier, you're actually going to get theoretically less delays and better quality of service. So actually, that's an argument to allow them to merge, in my view.
Yeah, as long as you can sell the bundled price at the same or lower than the ULCCs do, which I do think a lot of the times basic economy comes pretty darn close. So we'll see.
We'll see. I mean, at this point, I'm far less worried about losing the trial. Of course, there are still risks there, but in my view, I'm far less worried about losing the trial than JetBlue just trying to get out of it somehow. I don't think it'd be easy for JetBlue to get out of. It's very hard to call a material adverse change. But in terms of the world in which these things get alleged, alleging a MAC is pretty easy. Proving a MAC in court is almost impossible, but alleging a MAC and destroying my equity value in the process is easy. That's my principal concern. And it's abundantly clear that Spirit's equity value today so this is another analogy to the Twitter case, right? I mean, made kind of life-changing generational money on Twitter, but the kind of risk all along with that trade was, well, if the Mac actually, tiny chance that it is, if the Mac actually can be proven or somehow allowed Elon to get out of it, Twitter equity is worth nothing or almost nothing. So, I mean, we're kind of on that similar path here with Spirit where, look, it's not going to trade at zero the next day if this deal breaks, but it's going to trade at equity stub option value. That's for sure. What's that? $3, $4?
Yeah, that's what I was looking at. I was looking to comp it to Frontier, which is the most logical comp. And I was like, man, this equity's got some serious downside if this deal breaks.
Yeah, one way to think about it is look at JetBlue. JetBlue trades at half of book value, tangible book. It's not even burning cash. Spirit at half of tangible book would be like $5 a share, and Spirit's in a much worse position. So yeah. I think at this stage it would be, I can't put a finger on where it would trade, but if there was a zero chance of JetBlue going to say, look, if they allege a Mac, it's still not going to be priced at zero, because they probably wouldn't win. And then that's one of to your argument, or I guess to the pro merger argument is, well, how does it serve JetBlue to pull a Mac now? They'd still be litigated to close. Spirit would definitely try to enforce at this point. They may still have to buy the assets anyway. It might take another year, and they'd be invariably much worse off in a year.
Oh, yeah. I think all the incentives are to close. I really do. I mean, the CEO, he's either going to get fired or he's not. You might as well do the deal. I mean, he never should have agreed to the deal, but like he did. So you're going to like stop now? I don't know. Maybe.
Look, I agree. I hope you're right. I mean, it's just very rare. And going back to my earlier point that these things are there's always something. I mean, that's what makes the game, right? That's what makes it interesting. If these were all carbon copy situations exactly like one another, one, there'd be no opportunity to make money, and two, there'd be much less interest here. But here you have kind of all these interesting intersections of motive, financial logic, personal logic, kind of legal arguments, super interesting, complex, detailed legal arguments. And you also it's dynamic. That's what's great about it. It's dynamic in that, these companies are announcing earnings as we go along, and the business is changing by the day almost. So it's like these things are very dynamic, and it's very rare. I cannot recall one that I've been involved in where literally the acquiring company would be, I mean, if they close the deal, they may well have to close it. It's like a massive millstone around their neck, but it's going to sink them to the bottom of the ocean probably if they close the deal. Like pro forma net debt at JetBlue would be like $7.5 billion, and they'd be doing like more than that actually. What I'm talking about, 5 point, more, a few billion more, and they'd be doing pro forma EBITDA of $1 billion, under $1 billion, I think.
It's kind of wild. No one is. There's not like a ton of sellers in JetBlue. The insiders.
Where do the JetBlue converts trade? I mean, one way that you think about this is you get long Spirit stock and you short JetBlue debt. Because if the deal goes through, their debt will get crushed. And even if the deal doesn't go through, they're still a bit levered, right? And the interest rate environment's tough, so it's not like the bonds are going to rip. Maybe they do. But they only have one bond outstanding, the 2026 converts. So I don't know where those trade. All the other debt is like EETCs or private, term loans or whatever.
The 2026, $750 million? Senior unsecured.
Yeah.
It yields 15.8%. Trades at 70 cents on the dollar.
That's already pricing in the deal getting done. But see, that's interesting because that's pricing in Spirit senior secured 8% to 25. Okay, so Spirit has a few bonds outstanding. The 8% senior secured, so it's secured by the loyalty program. And it has a second lien on a bunch of the unencumbered assets at Spirit, which last I checked were about 500 million, maybe a bit more. So that bond is trading at 87 or something. It's trading not quite 15% yield, but trading low teens yield.
Which one are you looking at? The 25?
Yeah, the 25, 8% of 25s. So that's super senior, right? But at a much worse entity, like a much more stressed entity. Like JetBlue standalone today is modestly levered, but nothing scary, right? Like lots of options, okay? So you have a 2026 senior unsecured piece of debt, which, by the way, there isn't a huge amount of secured debt ahead. I mean, there's the EETCs, which are backed by the aircraft, but I'm talking about unsecured debt against the unencumbered assets. I don't believe there's a huge amount of bank debt ahead of you, and it needs to double check that. But yeah, so a much better credit out a year of an entity that's going to merge with the really shitty credit is trading wider. So it seems to me that the debt market is already pricing JetBlue closing this deal, right? Or
I don't know. I'm looking at Spirit, the 2025. Maybe I'm not looking at the right bond, but I've got it at trading at a 15% yield also. But
well, that's what I'm saying.
I could be
that's
wrong.
What I'm saying.
Okay,
Spirit is invariably a much worse credit.
Yeah,
right? Spirit standalone is almost bust.
Okay.
In my view. Not almost, but I mean, they'd be going concern in a year if things don't improve, okay? So that bond standalone should not be trading tight to JetBlue. The fact that JetBlue is I mean, it's a similar maturity. It's a year or different. But
yeah, okay. You're saying if the credit market did not think this deal would go through, JetBlue would not be trading at this level of distress.
No way. No way. That would be trading 10%, sub 10% yield, like lower, tighter. So that the debt market is pricing in a pretty meaningful chance that this deal is going through. And the equity, Spirit Equity, is pricing in like a 35% chance this deal goes through, according to my math. So there's probably a trade there. There's probably a trade where you can do something on the bonds versus the stock, but above my pay grade.
Yeah, I mean, just for context, Delta, which is obviously like the best of the best in that industry, but their 2026 bonds look like they're yielding 7.1%. So that's a big spread.
I mean, dude, get 7% to own Delta credit. It's pretty good.
Yeah, it doesn't seem terrible, right? It's like you actually get paid on it. And I think the probability you don't get.
Why own that when you own treasuries at 5%?
Yeah. Well, soon enough, the corporates will be better than the sovereign, but I don't think you're wrong. I don't know, it's an interesting time. They always are, but I don't know. That was a fun little discussion. I hope somebody got a peek into your mind. I appreciate it.
Yeah, man. Thanks. Yeah. Thanks. I hope it went in directions you wanted to go in.
Yeah, it definitely did. I liked that last little one. That was good. And this time I let you talk more, which is a positive. So, how's life? You good?
It can go hours. Yeah, it's good. It's good. I mean, yeah, trying to decide what the next move is, right? So we're in Tokyo, and my kids are 2 and 4, and so the older one is going to school in 2025, kindergarten. So we're kind of planning on moving back to Australia at this stage, but like I bought a house in Sydney. It's where I'm from, but yeah, this whole latest geopolitical stuff has kind of got me. I mean, not that Australia is super dangerous or anything, it's not that, but there were obviously some negative reactions to recent events that kind of shocked a lot of people in that community, as many communities did. And Japan, the safety premium in Japan is looking a hell of a lot better. Let's just put it that way.
Huh. Interesting.
Yeah, I'm super bullish on Japan, man. Like I have almost no investments in Japan other than kind of currency, and I rent here, right? I don't own any assets in Japan. Nevertheless, it's just crazy. The value proposition in Japan is just makes no sense. It just is so stupid. Like, I told this anecdote on Twitter, and someone got mad. The guy who was the subject of the anecdote, I don't think he got mad, but he kind of got a little bit upset. But basically, this guy came to visit me from New York. Not to visit me. He was in town, and I had lunch with him. And, he's a hedge fund guy, really successful guy, young guy, whatever, has means, right? And he's based in Boston or New York or something. And we go out for lunch. We just go to this random place, like not a fancy place, just a tempura udon place, like a typical kind of lunch spot. And, each lunch is like 1,500 yen, okay? 1,000 yen, 1,500 yen. So it's like $7 to $10. And, for 1,500 yen, you get a full meal. You get like a tray, and on the tray you get the noodles, and you get the tempura, and you get the soup, and there's like 3 or 4 things. So it's a great deal. It's all delicious, obviously. He's looking at the menu. So I look at the menu, I'm like, okay, I'll have that udon tempura set, thanks, and a glass of water. And he looks at the menu, he's like, okay, I'll have the vegetable tempura, and I'll have the meat tempura, and I'll have the pumpkin tempura, and then I'll have the soup. And he orders 3 soups. And he keeps going, and he orders like 7 different things. And we're at this tiny little table. And the lady's like, brings 7 dishes. And then I said to him, I said, dude, why did you order 7 lunches like a psychopath? And he said, you don't understand. In New York, each one of these things would cost like $50.
Yeah.
Okay. I'm getting $300 worth of food and it all tastes way better I'm getting $300 worth of food for $40. It's like, it just doesn't make sense. This stuff, I have to try everything. I have to try one of everything. It's just too good. And like that anecdote, repeat that 1,000 times. Literally every single person coming to Japan on vacation, and there's tons of tourists with the yen at 150, they say the exact same thing. They're like, I don't understand. I go to like a high-end steak restaurant and I have a beautiful piece of Wagyu and it's like $50, whatever it is. I mean, of course there's very high-end places, but they go to a really nice restaurant and they have some kind of delicious meal, even gourmet or not gourmet, and it costs like some tiny fraction of what it costs in, obviously New York is expensive, but the interesting thing this time is almost all of them are saying not just about fancy food or dining. They're like, listen, I go to the 7-Eleven and I just buy a bottle of water and it's like 100 yen. So it's 70 cents. In New York, it's like $2.50. And, in Australia, they'll charge you $3-4 for a bottle of water. It's literally 4 times the price. And look, some of that is economies of scale. It's a much bigger market. A lot of food is produced locally. But it's just the wrong price. Like, inflation has happened for a number of years now, noticed or unnoticed in foreign markets. And it hasn't happened in Japan. And there's going to be a massive transfer of value from people who, and this is going to happen quickly and it's going to happen slowly, but people, do it via buying real estate in Niseko or these ski towns, and they do it via traveling to Japan and consuming goods in Japan. They do it by buying real estate in Japan and ultimately trying to move here or whatever it is. So these things will equal out. I'm far from a currency trader. I know nothing about currencies. Every time I trade a currency, I lose money. So don't rush out and buy the yen. But yeah, it's very rare in my kind of 15, 20-year relationship with Japan. And in that time, I've lived abroad and come back. So, I've lived in Japan full time for on and off for 7 years total. But I've never seen an environment where prices in Tokyo are literally half the price in New York City. Like just as 2 data points. Normally, Tokyo is mostly expensive versus New York, just on the ground. Whether it be
that was
hotels,
my perception.
Yeah. For most of the last 20 years, it's been either more expensive or parity, let's say. Now it's half the price, half. Like you go to a Starbucks here in Japan, you go to a Starbucks, so equivalent level of quality, and you pay 1,000 yen, you get a coffee, you get 1 or 2 coffees and 1 like food item, 1,000 yen. In US dollar terms, that's $6. $6.50. What do you get for $6.50 at Starbucks?
I get the opportunity to jump behind the counter and serve myself. No, I don't know. You probably get 2 coffees. You get 2 coffees, 2 venti blondes.
For $6.50?
But you can't get anything fancy. You can't get any. No, it's $7.50.
$7.50 for 1 or for 2? That's actually not
you can get 2. You can get 2, but these are like the drip. You're not getting anything. You're not getting any pumpkin spice latte or anything like that, or any cold brew.
I see.
And cold brew, you're at like I think you're probably around like $5. I haven't been to. I go to Starbucks a lot less frequently now. I don't have a lot of reasons. What do you think about this? You buy into the corporate, what is it? Like the discipline and like moving people to the prime exchange and off the prime exchange, kind of shaming some of the companies. You think that's going to matter?
Yeah, I mean, it's one of these things where it's definitely a positive, okay? Like you'd rather have it than you wouldn't. I'm not going to say it's negative. I should caveat these comments, like if you're kind of a long-term investor and you're playing in large caps and you're looking for a reason to get more bullish on stocks that are already, cheap or doing well, that's a great tailwind to have. Do I think it's a panacea that's going to cure structural attitudes towards shareholders in Japan? No. Do I think it's going to, in the game I play, the value extraction game, as opposed to the ride-along game, right? So a lot of these guys, they value act or whatever, okay? No one really wants to get their hands dirty, meaning they don't want to be seen as the bad guy, which I understand, right? They have outside investors. They raise a huge amount of money. They want to work with management. They don't want to work against them. They're aware to the cultural peculiarities or cultural values in Japan that are different. So they're never going to go activist in the sense that they're going to try and kick out the board or whatever. So for them, of course, this is a great tailwind because it's kind of like, an internal change. It's promoted from within. Unfortunately, my cost of capital is higher than that. Like if Value Add takes a position in Olympus or in 7-Eleven, and they've been frustrated in that one, but if it takes them 5 years, okay, they have the patience for that. I'm more impatient. My cost of capital is extremely high. Like I don't want to lock up capital for that long, and if I do, I need a really good reason. I'm definitely going to get it out. So at my end of the pond, call it sub 500 million market caps, it's a much more glacial pace of change. And there's a few reasons why that's the case. One is necessarily larger companies, more multinational global companies, which are listed on bigger exchanges, tend to have more diverse shareholder bases or diverse perspectives anyway, just from years of being larger companies. So they're more aware, and they're also more aware and more affected by this kind of TSE change in policy. Like, what does $100 million company based in frickin' Fukuoka care about being on the prime exchange or not? They're already some kind of little local sports team that they sponsor the sports team. The guy plays golf with the mayor of the city. They're not graduating to sell their product in San Diego in a year anyway. Oh, you know what I mean? Like, of course there are some exceptions, but like there's all these podunk little junky companies where they're someone's personal fiefdom or they're the town's personal fiefdom. They don't care about what exchange they're listed on. Their shares barely even trade, or they hardly even trade. So there's a whole tail of Japanese nets, 100 plus of them, where, again, the value is there in plain sight. There's no debating the value, but it's how do I extract the value? Do I think these current rules, which mostly affect the larger cap companies, do I think that's going to somehow filter down to the dregs and affect change? Yeah, maybe in some kind of mild positive way, but I'm looking to get in there and really extract the value. Like I'm not looking to ride along while some manager who doesn't own shares in the company, who's kind of, if he's increasing the dividend payout ratio from 15 to 20%, that I'm going to go away and be quiet. It's not really my style. Because I don't have a broad enough mandate for that. I don't have the ability to spread my eggs around 100 different baskets while I wait for that to happen. I kind of pick my spots, be a bit more tactical and try and extract the value for myself. So from a selfish or a personal perspective, doesn't really affect. I mean, there is a couple of interesting situations in Japan that I have been involved in, and I mean, it's kind of in the weeds. So I don't know how interested you guys are or your audience would be, but I mean, some of this stuff is just, if you could actually get in there and kind of get creative, you could create a lot of value in a real hurry. So there's a Itoen. Have you heard of the company called Itoen? Itoen makes the best-selling tea drink in Japan. It's a consumer staple. Well, it's a consumer discretionary, I guess. They have a huge market share in tea, green tea. Like, huge. This is a company Coca-Cola would love to buy. They have their own distribution. They have their own tea masters who conduct classes around the country explaining the wonders of Japanese tea. So they have this brand of tea called Oi Ocha. Ocha just means tea, green tea. And they sell it in bottles. You buy it for it's delicious green tea, non-sugary, whatever. And, it's kind of your typical sleepy Japanese, I don't want to say mini conglomerate. They also own a coffee chain. They have a few other brands like vegetable juice, whatever, consumer packaged goods, but most all their profits come from, like 80+% of the profits come from the tea business. And, it's a typical sleepy, under-earning Japanese corporate controlled by Japanese family. They own like 30% of the stock directly, another 20% of the stock through their charity, whatever it is. So they own 40 to 50% of the company. Okay, so it's a controlled company, for want of a better word. It doesn't trade particularly cheaply. I haven't looked it up recently. Maybe I should pull it up. But last I saw it traded at, 20 times earnings or something. And it's been higher than that. I'll just pull it up right now. Itoen. Stock price is 2593. Okay, 2593. It's a 4.7 billion market cap. It's actually fallen off. Okay, so it's look, it trades 400,000 shares a day. Stock price 41. So it trades like $15 million a day, and the market cap is about 4 billion. So it's a mid cap by US standards. It's not small, not in kind of my typical neck of the woods, and it's not particularly cheap. What's interesting is the share structure. Itoen is the last company in Japan to have a preferred share category. They issued a category of preferred shares 15 years ago or something, maybe longer, as a kind of poison pill, because they issued, it's a long story, but basically they were worried they were going to get taken over by a Coca-Cola or whatever back in the day. So they issued preferred shares gratis to their shareholders at the time. Obviously the main shareholder was the founder, right? So he got a bunch of them. And they issued them at a massive discount. So the preferred shares are illiquid. So the main equity is 2593. The preferred share is 25935, I think. So it's not as liquid. It doesn't trade $15 a day. Maybe it trades like $1 million a day. So it's a huge liquidity premium on the main share. But this thing, same economic rights, but a better dividend. So you get whatever the common dividend is, you get that plus 20 yen or something, right? So it's either the same, but it's actually a superior economic return. And that trades at, guess where that trades? That trades at 1,800 yen. And it trades at 1,800 yen. So if you look at the valuation of the company, it's 4.7 billion through the common, and it's 2/3 less through the preferreds. Okay? Exact same economic, no, not exact same, superior economic interest through the prefs, just worse liquidity. So what can you do with this? Well, there is a provision in the docs where if the free float of the prefs falls below a certain percentage, which is not actually that low, it's like 20% or something, 20-25%. It's a rule of the Tokyo Stock Exchange that every stock has to have at least a free float of 25% or whatever it is, okay? And you can the free float is defined as shares in the general pool not owned by insiders. That's one of the categories. There's a few other categories. But basically shares that haven't traded in a certain number of years fall as well. Okay, so my idea was, okay, you go to the company and say, look, your preferred shares are a huge drag on your cost of capital. In the spirit of corporate reform and normalizing corporate shareholder governance and removing this impediment to full exploitation of corporate value, you should do something about these preferred shares. They literally trade at 70% discount to the common with the same economic interest. If you can figure out a way to get these shares delisted, right, then the provision in the docs means they'll automatically be converted to common shares. You can force the company effectively to give you par. You'll put in your preferred shares, you buy them at 1,800, you put them in, you get something trading at 4,700. Now, obviously, the share price of the the common will come down because there's a lot of value that will transfer from common owners to pref owners. But nevertheless, one, you can make this a historical argument. There are no other preferred shares in Japan. It's a massive weight. Two, it's trading in huge discounts. Doesn't do you any good. Okay? There's no benefit to you as an entity. You can't raise capital here. They were issued as a mistake. You should get rid of them. Three, the largest owner of the preferred shares is actually a charity. The founder's charity. So if you maximize the value of the preferred shares, you're actually putting money in a charity's pocket. Okay? There's not a bunch of foreign hedge funds. Yeah, some of them are owned by hedge funds. I own none of them, by the way. I used to own some. So you're not putting money in a bunch of vultures' hands. So I went to the company and I actually talked to them about this. I said, look, this is what you should do. You should either tender for the preferreds, borrow a bunch of money at 0% or whatever in Japan, tender for the preferreds, and do a levered recap, essentially, and buy them back. Or otherwise, someone will come along and try to acquire enough to consolidate the float, to force the TSE, to delist the equity, to force you to pay par. Pretty complex strategy, but interesting, right? Look, there's $500 million on the table for someone here. The preferred shares are about, what are they? They're not that small as a percent of the total number of shares outstanding. It's like 20% or something. So it's a $5 million company, maybe 700 million of prefs or whatever, 600 million, something like that. So you would need to find a way to concentrate the float. But given the ownership block's already there, you'd essentially, if you could find a block seller, this is an interesting trade, you could maybe acquire 5 to 10% of these, and then you either force the company to kind of engage with you on a dialogue, or you force them to increase the float. The only way they can realistically increase the float is to sell shares from inside their ownership group, right? So you either force them to take a big loss, or they sell new shares. Why would they sell new shares at a 75% discount? It makes absolutely no sense. That would be horrendous. And also in the current political climate, that's why it's important. If you did this strategy, and then the management's response was, well, we're just going to sell you shitloads more shares. We're going to crush the price. We're going to destroy the foreign invader. Oh yeah, by diluting everyone down 80% from where the common shares trade, that would not go politically in the current environment. You can make a very easy argument. You're just burning people. You're just burning shareholders for no reason to entrench yourselves and a backward-looking historical share structure that makes no sense, anachronistic share structure. So you could make a strong political argument now is the time to try it. But even so, you'd rather have management do it proactively because there's a lot of mechanical issues with A, acquiring the shares, B, ways they can screw you, and then downside, right? Like once you buy them, you can't get out of them. Like they're so illiquid. If I bought 5% of this company, they're either buying them back off me or I'm just owning them.
Yeah.
So like these kind of things, they're out there and I look at them. And I was involved in this situation for a time and tried to make it work, but even something like that was a bit too tricky, it turned out, in reality when I tried to make it work.
Interesting. Well, I'm going to wrap it on that, but this has been a good conversation, man. I hope you've had fun. I enjoy chatting with you. You're doing a lot more interesting shit than I am.
I got to, man. I got to pay the bills.
Yeah,
college ain't cheap these days.
Yes, well, same. But I got to figure out, I don't know. I got to figure out my solution. We'll see. It's not doing what you're doing yet. We'll see if I ever get there. I think the podcast probably isn't going to pay the bills anytime soon, so we'll see.
Never say never. Keep fighting the good fight.
I will do. All right, man. Have a good one. Thanks for stopping by.
Take care, buddy. Thanks for having me. See ya.